Welcome everybody. Today we're going to be going through the CoreLogic monthly chart pack, and it is for the month of May. There is some very interesting data in here. Let's minimize my face and get into the information. So first and foremost, Australian dwelling values have increased nationally by 1% over the past 3 months. This marks the first quarterly lift in home values since May last year. So arguably, you could say that the bottom of the market is behind us. That isn't to say that we don't have headwinds. There are still potentially more interest rate rises ahead of us. And if they do too many more of these, we may see a crack in the market. And it's a bit too early to tell what's going on with people's finances, just because we've seen 11 rate rises, and the average Australian with a mortgage it takes some time for them to become accustomed to that debt. And is it now becoming too expensive? At what point will we see some of those fire selling that some people have been talking about? I don't know if we will see it. We may not see it, just because a lot of people out there are scared to actually sell their home because they don't know where they're going to go. There is a really, really tight market. There's not a lot of stock coming onto the market, and there's not a lot of available rental properties. So people are kind of stuck in their homes, for want of a better word. Nonetheless, we've had 3 consecutive months of price growth. The price growth has largely come from the combined capital cities or the major metro markets. Sydney is leading the way at 3%. And there's a little bit of growth coming from regional South Australia and also regional Western Australia at 2.4% and 1.2% respectively. But when you look at the graph, it is quite obvious the swings in prices, where we're going into the downturn post April 2019, and it was COVID hit, and then we had a massive market stimulus. The market ran like crazy, and then we've had a huge amount of then we had the downswing, which is a number of rate rises, a lot of negative sentiment, and then we've kind of had that 10% market correction. But now we're well and truly coming on the way back up. Looking at the 12-month changes, again, you see similar changes in the graph, where we had that huge April 2021 swing upward, and then we've had that market cool off. And we've got early signs that the market is going to come back up, and it's, again, reflected in the combined capital cities. Now, this is one of the interesting graphs that I like to look at. It's a quarterly change in stratified hedonic dwelling index. What that basically means is they've broken up the property market into the lowest 25% values, the middle 50% values, and the highest 25% values. You can see that there's some obvious changes here, and it's not quite sure why we're seeing it, really, because you didn't anticipate the top 25% values to be hit the hardest by the interest rate rises. But the sentiment in the market is that a lot of these purchasers really aren't using much debt. And you can see in Sydney, that's where the biggest market has had the most amount of price growth. Top 75% has had 4% growth in the past quarter. So the richest part of the market seems relatively unaffected by the changes in interest rates and are feeling very, very confident and just spending their money. We've had price growth in the middle 50% and in also the bottom 25%. But another thing that is clear to me is the bottom 25% has been basically the best performing over the quarter in most instances. In Melbourne, it's suffered a little bit, but in Brisbane, it's performed the best. In Adelaide, it's performed the best. In Perth, it's performed the best. In Hobart and Darwin, we've seen negative price growth, but still, it is that more affordable part of the market has been pretty solid. Now, going into the housing cycles, let's move through here. Rather than going city by city, what I'd like to go is sales and listings. So this is where I think we're seeing such strong price growth and resilience in the market in spite of the rate rises. Normally speaking, when debt becomes more expensive, people can't afford to spend as much money. So, their serviceability goes down for a lot of people that are out there trying to get loans. You're seeing that interest rates go up. I can't afford to buy as much. But then also there's a bit of fear, so people don't go out there and buy as much property. The problem that we've seen in the Australian market is that the national sales numbers have been tracking well below the 5-year average. The monthly sales numbers are down and the 6-month moving average is down as well. So nationally, we have seen about a 21.5% decrease in sales volumes. So there just simply is not enough property changing hands out there. There are a lot of people out there that are basically sitting in their homes, sitting on their investment properties, and refusing to sell. The market that has been most impacted by this is Sydney at 29.1%. Yeah, about 30% less stock is being sold in the Sydney market, and that is being felt. A lot of the agents that I talk to are saying that the market feels very strong simply because there's not a lot of stock out there, and buyers have to compete if they want to buy their home or if they want to go out and buy an investment property. One thing that is clear is that the average days on market has increased. So across Australia, same time last year, it was about 23 days on market, but now it's about 33 days. So it's clear that it is taking more time to sell the property. And the most obvious where this has happened is in combined regional cities. It's gone from 25 days to 44, just here. Okay, so there is still a little bit of vendor discounting. Deals are getting done. Vendor discounting is effectively what the listing price was and then what they sold it for. So we are seeing price growth in the market, but what we're seeing is an adjustment in vendors' expectation, but then also in the way that agents are listing these properties. So the median vendor discounting across the combined capital city is about 4.1%. So you can still find a deal out there. Now, as far as listings are concerned, again, listings are an indication of brand new property coming onto the market. We're well below average. New listings have seen a slight uptick after the public holiday, but compared to the same time last year, we're 21% down. But we're also down on the 5-year average. We're 13.9% down on the 5-year average. So just the amount of people that are listing their properties, it's down significantly. Okay, we'll keep on going down here. At a national level, listings are still significantly below the 5-year average. And that's just across the country. There's just not a lot of stock available to sell. Clearance rates remain strong, basically at 65%. What that tells you is that it is a strong market. When the clearance rate is at 65%, that basically is a market that is not moving or starting to increase. The rental market is going crazy. The average growth in rent values held very strong at 10%. And across the combined capital cities, rents grew by 11.7%. This is the highest annual increase on record. This is just a sign of the fact that there's a real strong rental market. There's not a lot of available stock out there. So this is a great thing for investors. They're seeing their properties increasing or the rents increasing significantly. Terrible if you're a renter out there. Well, it's an opportunity if you want to be a rent investor. Gross rental yields are increasing 3.9%. So the net difference between interest rates and the yield is negative, but we are seeing that increase. So the combined regionals are 4.6%. And I think we're going to see this net yield continue to increase over time. And this will happen just as a result of the amount of stock that's available. I keep on saying this, but let's have a look at the dwelling approvals. So the monthly dwelling approvals fell slightly in March, but largely they are both trending well below the decade average. So you can see here the decade average for houses is well below where it should be, and the decade average for units is again well below where it should be. Decade average for units is about 8,000 per month, I think that is, per month. And here it's sort of sitting at about 4,000. It's about half. Interestingly, new house finance secured is starting to increase. So basically, we're seeing that people are starting to get their pre-approvals in place. New lending for investment homes is starting to increase as well. It's still below the 5-year average, but it is starting to increase. Both owner-occupiers and investors are stepping back into the market. Again, first home buyers are starting to come back. So the value of first home buyers rose by 12%, 12.3%. And this is historically first home buyers show strong finance or show an early response to a bottoming out of prices. So we saw the market drop about that 10%. First home buyers have seen that. Prices are bottomed out. They're feeling more confident. They're stepping back into the market and say, I want to buy a home. Okay, another interesting thing here is mortgage origination for riskier types of lending is notably lower. Basically, riskier lending, which is 90% LVR or above, is tracking well below. It's starting to really sink. Two things. One, banks are not approving these types of loans or making them really expensive. But two, also borrowers are just saying, I don't want that kind of risk or that much debt against my home, which is great for both owner-occupiers and investors. You can see here it's tracking it's tracking downward. So people are not taking on as much debt as they were. For regional markets, we're seeing it is less popular than it was, but it is still way more popular than it was as a tracking above the decade average. So the portion of homes that took place in sales that took place in regional Australia is estimated about 30% of home sales, 37% of home sales for the month of 3 months up to April. This is down from the peak of 42%, which was during the COVID times, but it is still above the decade average, which is 35.3%. So it's still tracking above the decade average. Basically, there is a flavor for regional homes, that feeling that you can work from home, that you can go and find something affordable and buy yourself a higher quality lifestyle in the regional centres. It's still there. Okay, that is the monthly chart pack breakdown. I hope you've gotten some really interesting data. For me, the big summary is that the market is starting to improve. It's still too early to tell if we're going to see a massive increase in price, but with the amount of stock that's on the market, which is trending well below 5-year averages, and also we're seeing very low approval ratings, approval of houses and of apartments, it's hard to see there being more stock, more listings coming onto the market. Time will tell. Happy investing, happy house hunting. Catch you all later.